Morning, Fractal Effects team. We're still following the market from the morning session. So if you're joining us, please make sure you read the disclosure in the footer section of fractaleffects.com. If you're following along, make sure you're doing a demo account, as this is for educational purposes only. We are not financial advisors, and this is not financial advice. So usually on a week like this, we don't trade Wednesday, Thursday, and Friday. We just take the week off. You trade Monday and Tuesday, see if you get your setup. But yesterday didn't give us much. And today, even though I'm not interested in trading, we're going to use today and tomorrow for educational purposes. We're going to specifically go over certain concepts and certain features of the market translator. So we are in the middle of a rebranding. The blue zone strategy will still remain the blue zone strategy, but the indicator itself is being rebranded to the market translator from blue zone. But what we have here, let's pretend for a minute that today was a regular day, but we do have some news. We have FOMC meeting minutes dropping at 2 p.m. Usually when you see anything related to FOMC with a red folder, you want to stay away from it. We do also have another member, I believe it's Waller speaking at 11 o'clock Eastern Standard. It's showing up as an orange folder, but you still, again, want to just veer away from it. So we're seeing an interesting pattern. We have a double break to the downside for both US 500 and NAS with a blue zone that was created in real time but untapped. Anytime you see a blue zone that's untapped, like created in real time and untapped, there's kind of a sense that you're going to get a runaway market. When you get a runaway market, there's one of two things. I personally hate a runaway market because you're trying to chase it. There's only one place you can possibly even look for an entry in a runaway market, and that's the first fair value gap that's created after 10 o'clock. That would be right here. Now we're seeing this gesticulation here. We're seeing a reversal with 48 seconds left. That's an engulfing candle. But as mentioned before, this is not only a week that I would not be trading, but this is a pattern that I personally don't like trading. So when you see a runaway market, you're not trying to chase it. You don't try to chase down a runaway train. You try to wait at the train station. So when you see a pattern like this, where you have a new blue zone that was created in real time, right here, and the market punched past it without even tapping it, that's a runaway market. And this is the only place you can even possibly look for an entry, but this is a low probability pattern in general. So there's your first presented fair value gap after 10 o'clock. Write that down if you're following along, you're taking notes. The first 5M fair value gap presented after 10 o'clock Eastern Standard, 7 o'clock Pacific, you want to mark that fair value gap out. Lucky for you, I get rid of this right now, our indicator does it for you. You just have to lay out the box. It shows you where all the fair value gaps are. If you're a beginner, you want to be able to paint a fair value gap by hand and know and understand exactly why that 3-candle pattern exists. But the spotlight indicator paints out these fair value gaps for you. All you got to do is go in and just create a box over it. So you can extend it right and see exactly what's happening. So do I think the market's going to drop from here? There's a higher probability that it can, but keep in mind, today is not a day anybody should be trading. You got to look at this as a job. We have a special job where apparently we can take 3 days off in a week, but on a week like this, you want to trade Monday and Tuesday. You want to look for a high probability trade setup within your window of opportunity. And then you want to take Wednesday, Thursday, and Friday off because we have Fed Chair Powell speaking later this week, and we have FOMC meeting minutes at 2 p.m. today. When you see that, you want to avoid it, but I'm still going to go over some educational stuff, and there's a higher probability the market will drop from this fair value gap. That's the first presented fair value gap after 10 o'clock. When you see this blue pattern, when you see a blue zone being created in real time that stays untapped, that's called a runaway market. We do not want to chase a runaway market. So now it's coming back into this 10 o'clock fair value gap. Sorry, 1 second. Just click away from that. So we see that gesticulation happening here. We could possibly consolidate for a while. It might just take out these highs, but usually you want to see if the market is not going to retrace back here, because what happens after a double break? We get a retracement back to our blue zone. But when you have this big of a drop and the blue zone remains untapped, then this is usually the foothold. If it was any other day, I might be interested in looking for a trade setup from here all the way down to here. But again, this is not the week I want to mess around. You mess around on a week like this, you get your face ripped off, especially if you're a beginner. If you're a beginner, this is not the kind of week you want to be in the markets. Even yesterday, as mentioned before, Monday and Tuesday is okay to trade, but yesterday didn't give us anything. That's a sign. That's a sign that this whole week is going to be either runaway markets and or big pushes back and forth. You're going to see a lot of wicking back and forth. But we're going to use today to just go over some educational things. So we have a downside expansion model slightly. Downside expansion model, we had a buy model, but the buy model crashed right into the DSD, and it's using the daily standard deviation as an inverse. Now, this is what an inverse is for beginners. When a fair value gap gets filled in, it automatically becomes an inverse. That means it can be used on the other side. I'll show you an example here. Bring this down. Usually this happens a lot with the first presented fair value gap, what we call the NYC fair value gap. So right there was left open. You can see this was left open, this new blue zone was left open, and even the DSD. None of these came, like the market did not come back to tap any of these. So that's why this becomes an important zone. If the market does not drop past this, sorry, 1 second, not sure why this is freezing up. So the market can use this as a foothold to start climbing down. But if this were to get filled in, if a candle were to close above here, then this would become an inverse fair value gap, meaning the market can then tap it on the other side of it, the midpoint, and start climbing up. So fair value gaps are good for only two uses. One is the actual tap to push down, and then once they get broken and violated, then they can be tapped on the other side to climb back up. That's why in the blue zone strategy, we look for an inverse fair value gap and a fair value gap before we start actually moving in the direction of our bias. Because then it's using two different points of confluence, an actual fair value gap, and then it's using an inverse fair value gap as my second foothold to start climbing back up. So again, if this was any other day, that's where I would have looked for a trade setup to push down and take out these lows and most likely into this 4-hour fair value gap. But this is not a day you want to be trading. I just want to go over the basics of why this works. So the first presented fair value gap after 10 o'clock, and you've heard other traders possibly mention this zone as well. ICT, for example, calls it the silver bullet. There's a couple of other traders that have coined other things. Forget what they call it. I'm telling you why it works. So when you have a runaway market and you see a pattern like this, the market does not want to climb all the way up here. When a blue zone is left untapped, this is what they don't tell you. This is what ICT doesn't have built into his strategy because he's not looking at it from a mathematical perspective. So when a blue zone is untapped, what that's letting you know is that this market is extremely bearish. Usually after a double break, we wait for a retracement back to the blue zone. But when a blue zone remains untapped and an NYC fair value gap remains untapped, that means this market is extremely bearish. And in retrospect, if it was going in the opposite direction, that would be extremely bullish. So when something is extremely bearish or extremely bullish, they want to use the first fair value gap that's presented after 10 o'clock as its foothold to start climbing down. So that's why this zone works. A lot of traders call it different things, but that's why this is what it is. But that's the pattern. The pattern is the second you see a blue zone untapped and an NYC fair value gap untapped, that's a runaway market, and a runaway market will most likely use the first presented fair value gap after 10 a.m. Eastern Standard, 7 Pacific, as its foothold to climb down. Now, it's not as simple as that. You want to obviously still look for the same patterns. You want to reject off of here. You want to create a fair value gap, tap it, and then on a 1M, create a fair value gap and tap it. You still want to use it the same way as if it was a blue zone, as if you did get that retracement. Otherwise, you're really kind of just risking it because you're putting your stop loss here and you're putting your take profit here, but this could consolidate for a long time. It could even wick up here, but still the body will close in the 10 o'clock zone, or high probability, I should say, that the body will close in the 10 o'clock zone and then drop. Because if everybody's going in right here, and all these traders have coined this zone, so there's a lot of users and a lot of traders that just know this is a good zone to take a drop from, then it only makes sense for them to consolidate, manipulate, and drop it from here. So be careful. That's one of the reasons I don't even like this pattern. I personally do not trade this pattern because it's associated with the runaway market. There's 3 different models you're going to get. You're going to get a bullish, a bearish, and you're going to get a runaway. When you see the bullish pattern, it's easy. You wait for that setup. When you get a bearish pattern, you wait for that setup. When you get a runaway market, it's extremely bearish or bullish. Like there's no way you can catch this. And this is the only time you can, but you're risking a lot. This is the thing that most traders don't get. They think just because they wake up and they turn on the charts that they have to take a trade. You do not. Day trading is not everyday trading. You need to get that into your mind. You have to be able to look at these patterns and know immediately. And then once you become a professional, look at the Forex factory. You can just see entire weeks you're not supposed to trade. So we would not be trading on a Wednesday, Thursday, and Friday of FOMC. We take that week off. We go relax. But we're in here teaching you a couple of things. So that's our, if it was any other day setup, if it was any other day, this model is perfectly set up for what's called a runaway 10 o'clock tap. We'll come back and check on this. This is not, you should not be trading this. This is just to show you guys what would be a high probability trade setup on any other day that was an FOMC week. So we'll come back and take a look at this, but this is NAS, and this is the only thing, and you'll see that US 500 will also fall in suit here. From there's the 10 o'clock presented fair value gap. So that's the first fair value gap created after 10 o'clock. Market usually taps it. This one's already created a 5M fair value gap and tapped it, so this is actually more higher probability, and it's running to this 4 hour. If it was any other day, I actually wouldn't mind taking this one, just because we have already a triangle pattern from US 500. So US 500 took out the highs first, created a break, meaning the market wants to push down. That's the manipulation move. And then we had a double break to the downside. That triangle pattern of a break and a double break in the opposite direction is gold, as long as it fits the rest of the blue zone model. So same thing, it created a blue zone in real time. There's the NYC fair value gap, and it didn't tap any of these. So that's a runaway market. There's your 10 o'clock first presented fair value gap. There's your first 5M fair value gap created after that, tapped on the 1 minute. And we got 3 minutes, 43 seconds left, most likely. Let's see if this, bearish confirmation sticks. And then you have all the confluence that lets you know that this market wants to push down to that 4 hour fair value gap. But stick to your rules. I've said it a million times. Just because I know where the market's going doesn't mean that it fits the rules or the parameters that I've set out for myself. I do not trade FOMC week. That's how you prevent greed. So we'll come back and check on this. I feel like the longer I stay here, the more of this analysis that I give, we might see some people foolishly jump in, but that's not what I'm trying to promote right now. I do not want people to be trading, especially not beginners, on a day like today. So we're going to switch over to oil real quick. I'll leave US 500 because that's the more optimal pair. We're closer to getting a bearish confirmation here. And then after a bearish confirmation, you can always get a retracement as well. Remember, there's an 80% chance you'll get a retracement after you get a bearish confirmation. That's why this top could get swept. That's why this top could get swept, this 20 EMA could get tapped, and then the market could drop. But as soon as you see a bearish confirmation, you cannot, if this was any other day, you cannot buy this market. That's the beauty of this strategy and the market translator is you only have, it's a 50-50 deal, right? It's a buy or a sell. But the market translator will tell you when you cannot do something. So if one of those options is removed off the table, now you don't even have to look for a buy. You don't hope that the market's going to manipulate and go in the opposite direction. You just look for a trade to go bearish. And if for whatever reason that still fails, that model fails and you did all your analysis, because nothing's 100% in the market, but even if that trade setup fails, you can chalk that up as a business expense. This is your business, this is your career. A loss is just a business expense as long as you followed all the rules and did it right. If you didn't follow all the rules and you lost, that's on you. Then feel free to kick yourself. I would. But if you stick to the rules, it's a business expense and you can't feel bad about it. So if this was any other day, this is actually close to a setup that looks interesting. But as mentioned before, FOMC week, it's just not prudent, especially for beginners. But we're red across the board here on all higher time frames, 1, 5, and the 15. Those are the ones that you want to look at when you're taking a trade in the direction. 58 seconds left. You know what? We'll wait to see if this confirmation sticks at least. We're hitting a 15-minute fair value gap here on NAS. This won't stop it. But a bearish fair value gap could lead to a retracement to sweep out this high before the market drops. That's why you want to proceed with caution. But it's the second in 37 seconds, if this bearish confirmation sticks, the probabilities go up that this market is going to drop after a retracement. So I'll still give you like a retracement back to the 20 EMA most likely, excuse me, and then a drop. 13 seconds left, and then we'll switch over to oil just to see what oil's doing. Today was also a day where we had crude oil inventories, so that news dropped. Remember to check the economic calendar for whatever it is you're trading. If you're trading oil, you want to check the energy calendar on Forex Factory. If you're trading the indices or Forex, you want to check their economic calendar. So there is the bearish confirmation. Now you cannot buy this. There is a higher probability that after a retracement, this market will go right into this 4-hour fair value gap. The only thing that will disrupt that, again, is the fact that this is FOMC week. That's why we don't like to trade this week, because they do a lot of manipulation, where a pattern looks almost too perfect. What do we have? We have a triangle pattern. We have a bearish confirmation. We can get one last swipe back up here towards the 20 EMA and then a drop. But that's the only thing that this thing is really telling us right now. I'm going to switch over to oil real quick. We'll keep this as is and we'll watch, because I'm still interested in that retracement. At the very least, to take out these highs. These highs, and then potentially these highs touch that 20 EMA, and then we could see a drop. But that's how patient you have to be. That's how ice cold you have to be. That I can call this, and it most likely will go exactly as I said, but I still don't want to take it, just because I've trained my brain to not mess around on days like this and weeks like this. That's where your rules save you. Even if today might have been a win, guess what? On another day, it might have been a loss. Is that really worth it? So let's switch this over to, we do have actually 3 minutes left before this confirmation sticks. But we're going to switch this one over to oil because I'm not even interested in NAS right now. This is US oil. We just had the oil inventories news drop at 10:30 Eastern Standard. Look at that wick. That's what that is from. Again, know when the news is dropping to prevent this. But this gave us a break to the upside. It did not create a bearish fair value gap, and then we got an instant break to the other side. What do we have here? We have a mixed model sell. That means we have an upside expansion model, but we broke the blue zone to the downside first. Again, a very mixed bag. London gave us a double break. We did a retracement, deeper retracement here, and then took out those highs. So London obligation's been met. And New York gave us a break to both sides. What happens when you get a break to both sides? You want to wait to see which one gives you a double break. Then you have a triangle pattern. Triangle pattern is a break in one direction and a double break in the other. As long as it matches your buy-sell model, that's one of the easiest setups you'll ever see. If you have a buy model and you have a triangle pattern to the upside, meaning the double break is to the upside with a break down here, then the first presented fair value gap is gold. And we're working on the next iteration of it, which will paint that out for you. But right now we have a break in either direction. So oil, we'd have to see which side gives us a double break. Look at all this consolidation. Again, you can just eyeball it and tell that you don't want to trade this. You should not be seeing 1 to 2 hours of consolidation on the 5-minute time frame. That's disgusting. So 50 seconds left. Let's see if we get this bearish confirmation. If we get this bearish confirmation, now I'm hoping to get a double break to the downside. Why? Well, we already have a mixed model sell. So if I get a bearish confirmation and a double break, what's that make? That's a triangle pattern to the downside with a bearish confirmation. Then I just have to wait for the first presented fair value gap. Look how tight this range is. New York has not even created a fair value gap, like an opening NYC fair value gap, like this one right here, which the spotlight the spotlight indicator paints out for you. So New York has not even painted one yet. 3 seconds left. I think we'll get this. There you go. There's your bearish confirmation. Now I'm hoping for a double break to the downside. That gives me a triangle pattern and a bearish confirmation, and we have a mixed model sell. So there's more confluence to the downside once we get that double break than there's to the upside. But once you get that confirmation, this is how you want to use these two strategies in confluence, by the way. When you have a spotlight confirmation in one direction and you have a double break in the opposite direction, you cannot trade that because you have two strategies that are telling you two opposite things. One is telling you that there's a 70% chance that the market wants to go up, and the other is telling you that there's a 85% chance that the other range of that dealing range will not be broken and the market wants to go down. You can't trade that. That's how these indicators save you. Remember that. Capital preservation is your first goal. People think it's making money. It's not. Capital preservation is your first goal. Making money is second. So we have not gotten a retracement on US 500. I'd still like to see remember, 85% chance that the market will retrace back into our dealing range once we get that bearish confirmation. There's our dealing range, the gray line. That's where it begins. Now we did wick it right here, but I want to see a deeper retracement, at least to take out these highs. Rarely will you see a clean drop. Usually it comes back in, takes out anybody who got in here, or even anybody who got in here. So after a spotlight confirmation, I actually like to see it retrace back to the 20 EMA unless it's already done what's called an early retracement, which this is not. Early retracement is the second we get a crossover, the market comes back and touches it, and then drops. Now it could just drop away from here. But again, the higher probability is that you'll get a simple retracement at the very least here. So that's US 500 on the right. I'm not interested in NAS. There's no point in even using, like, you can only use an asset as a diverging confluence point until it's delivered. So NAS is falling in suit with US 500. Now they're both heading to, this one's heading to the 4-hour fair value gap, this one's heading to this 4-hour fair value gap. But this one's closer. Whichever one's closer, I've said this a million times too, when you're using a diverging pair, as soon as one of those diverging pairs delivers to the higher time frame PD array, be it a 4-hour fair value gap, a 4-hour liquidity zone, you got to act and treat them as if they've both hit that point. So as soon as one of these hits this 4-hour, you're done on both of them. That's the only way divergence works. It means one's delivered and you're done. Let's say this one delivered. Let's say this candle comes down here and taps this 4-hour and you're still floating here, but you're in profit. Now you could take some off the table, roll your stops to break even if you haven't already, if you haven't hit that 2R yet. But the safer bet is as soon as this hits, they could both technically reverse. Because as soon as this hits the 4-hour, this might just take this green line. This green line is 4-hour liquidity, not a 4-hour fair value gap. So the liquidity comes before the 4-hour fair value gap. So what if this hit this 4-hour fair value gap and this just hit the liquidity zone? That's it. When you're looking at diverging pairs, as soon as one delivers, the other did technically deliver, just not to the point you thought it was going to. This one maybe just wanted to take 4-hour liquidity and not hit the 4-hour inefficiency and then start heading back up. So be diligent. Watch both until one's hit that higher time frame PD array, then you're done on both of them. But that was the only possible setup, and again, you could still get one last retracement back in here. Back to the 20 EMA. Oil didn't really give us much. Let's see if oil's setting up for something now. For anybody joining us right now, remember this is not a week you should be trading. Excuse me. On FOMC week, non-farm payroll week, trade the Monday and the Tuesday, whichever days actually have no news, no high impact news drivers, and you take the rest of the week off. Otherwise, you get your face ripped off, especially for beginners. So oil, again, we have a break in both directions. We have a bearish confirmation from the spotlight strategy. So that's how you use these two strategies in confluence. We want all of them to match up because they both have their own aggregated data. If one of them is telling you there's an 85% chance the market's going to go down, you want the other one to also match that and give you an extra 70, 80% chance that the market's going to go down because of a different strategy. But we still don't have a double break in either direction. I still think we're going to get a late retracement here. Sometimes the market likes to give you these anemic candles. Remember, each candle is telling you something. Every single candle, regardless of what time frame we're looking at, has an open, a high, a low, and a close, and each one of them is telling you something. Remember, on the higher time frame analysis, we use the current candle or sorry, I should say the previous candle to see where it closed. So on a 4-hour, if the previous candle closed below or above the one before it, that gives us kind of a bias of which direction the next candle, the current candle, wants to go. You can do that on the 1 minute as well. It's just moving a lot faster. So when you see a candle close down here, next one's closing below. But when you start seeing these anemic candles that are having a tougher time breaking below each wick, then you're slowly leading into consolidation, and then it could lead to that one manipulation move back up to the 20 EMA and a drop. Rarely will they give you something clean. So right now, this is the only fair value gap that was created. And then we have, again, the 20 EMA up here where it could swipe back up here and then drop. If you have any specific questions regarding not only just the market translator, our strategy, but just trading in general, make sure you drop it in the chat. We'll get around to it. We want to help you guys understand what's happening here. Remember, anybody who tells you that the markets are completely erratic, chaotic, they don't understand how the markets actually work. They don't understand that this is the most elegant algorithm ever created. It's based off of psychology and reverse psychology. And it's literally created to test your sanity. So that's why we created the market translator, to translate that information to you. Even when there's days where you can't find a good trade setup, at least the market translator is telling you what you can't do. It's telling you what you can do and what you can't do. So for example here, we cannot buy this market. There's no way we can get manipulated into buying this market. But you'll see it sometimes. When you get a double break and you see the market shoot up, there are some people that take a buy, thinking that this is the reversal point, the market's going up. But we see that it's a double break, and we know that it's really just retracing back to a blue zone or one of our key zones, and then we're going to look for a trade setup to go short. That's how this market translator protects you. It lets you know what you can do and what you can't do. I don't think oil is going to give us much. We're actually going to have a short session today, just because I wanted to go over a couple of concepts. This is not a day or a week you should be trading. Same thing with tomorrow. We're going to be live, but we're only going to go over a couple of concepts. We're going to have an early session tomorrow. So I'm going to leave you guys with some homework. Two things: US oil. Check to see if you get that double break, retracement back to our blue zone, and then a setup short to most likely take out Asia lows, unless it just does it on its own right here. If it's a runaway without any kind of retracement, without a double break, because right now it has not left. This is the only fair value gap that it left after this break. Right here. That was it. That's the only fair value gap that's been left. And it has not been tapped. So I want to see, at the very least, a retracement back into here, or a double break and a push down to take out Asia lows. Or if it just runs off without us, then there was no trade setup here to be had anyways. And then secondly, on US 500, two things. Using NAS. First things first, wait to see if you get that that retracement back to the 20 EMA, and then a trade setup to go short right into this 4-hour fair value gap. And secondly, even though on a day like this where everything is extremely bearish, both of these will most likely crash through this 4-hour fair value gap, if not even lower. Just see what happens as soon as one of them hits the midpoint of a 4-hour fair value gap. See where the other one is sitting as far as divergence. Does it want to start turning around and go back up? How many candles does it spare before it finally crashes through its higher time frame PD array? So those are the two things we'll leave you with. And again, you should not be trading today, tomorrow, or Friday, especially if you're a beginner. Please check us out on fractaleffects.com. Turn on your notifications, hit the subscribe button, so you know when we're live. And check us out on social media, fractal.effects. We'll see you guys tomorrow.